Welcome, everyone. We'll grab your attention for a second. Thank you for attending. We're glad we can have everyone back come out for an event like this, so thank you for joining us.
Especially with the way the weather's been outside. We will have a quick disclaimer showing up. The legal guys make sure that we have this, and so that you know what's going on, and we indemnify ourselves that way.
It absolves us of all liability, essentially. But have to make the legal folks happy. We're not going to do the whole presentation, just a quick note, then we'll enjoy the meal. But the agenda for the evening, we'll have a nice meal, then Kevin and I will chat about the recession, essentially, and then we'll bring up some of our guest speakers, Dennis Mitchell and Michael Baker, to help us answer the question, how to invest during a recession. A few notes. If you do want to leave to go to the bathroom, they're just across the hall, so just a quick jaunt on the other side of the hallway. We're also filming the event. They're filming us. They're not going to be filming the crowd, so you're not going to get your YouTube moment just yet. They're going to be all on the presenters for the evening.
No TikTok, no social media. We're not doing any of that. No Instagram. And as you can see, 7:15 is question period. We will have you out of here by 7:45 to 8 because we know everybody needs to get home for the Jet game. Mm-hmm. I think on that note, we can let you get back to your food, and we'll get up here close to 6:30.
Sounds good. Thank you. Hello again, everyone. We'll grab your attention for a second. I know we said we'd wait after the dinner is served. However, we're also cognizant of the time and trying our best to stay on schedule. So we will jump into a bit of the presentation while you finish the meal. We forgot to mention earlier for the questions. We certainly welcome the questions, but please jot them down and hold them until the end of the presentation. There'll be a couple of presenters, and then we'll do a roundtable Q&A towards the end of the presentation. So please hold the questions until then.
Yeah, based on that, let's start with what we are. I'm Kevin Becker. This is Clinton Orr. We are Becker Orr Wealth Management. We are a member of Canaccord Genuity Wealth Management. Now, Canaccord Genuity is the largest independent investment firm in Canada. We also have offices in Australia. We have offices in the UK. We have offices in the United States. We manage roughly $100 billion in assets, so it makes us a fairly large independent firm. Also, we are a member of what's known as the CIPF, or the Canadian Investors Protection Fund. This is the insurance scenario. So this is what protects your assets. It's the same insurance that the big bank firms use, and the main reason is because it gives you peace of mind. So that's who we are.
Yeah, I know we do this every time, but a little bit of repetition can be good. It's important, so we want to go over this. You can see on the slides there are the full-time members of the team. We have part-time staff in addition to this, but 5 full-time members. And as our team, our promise to each and every client, it is commitment, clarity, and confidence. For commitment, it's really all about communication. Things change. They change in your life. They definitely change in the financial world. We need to make sure those lines of communication are open. If we do our job there, it should lead to clarity of the goals, the objectives, when all the cards on the table when it comes to the portfolio, the returns, high level commitment, high level of clarity, the end results. Confidence in our team, in our process. Most importantly, I want you to have some peace of mind and confidence with your financial plan. I mentioned the process, so I'll quickly comment on that. We fully believe in financial planning. Our process, we gave it a quirky name. We call it financial architecture, but the analogy is appropriate. When you're building a house, you can't just zoom in on one piece. As much as I love to just pick out the big screen TV and then call it a day, there's lots of decisions that need to be made before I get to that step. Same thing in the financial world. You need to start with the foundation, which is your estate plan, your insurance needs. Then you work on the framing, which is when we talk about tax planning, retirement planning, and what we do there will influence the interior, which are the investments. So I know today we're zooming in on the interior, on the investments of that financial plan, but please keep in mind it's one piece of a larger financial plan. So with that aside, we may as well jump right in and tackle the main topic, which is recession.
Yeah, we want to talk about some of the reasons why we may see recession. And one of the big factors that's influencing this has been inflation. And as we can see by this chart, inflation's been all over the place. But for the majority of the last 20 years or 30 years, it's actually been on a lower trajectory. What we saw was an increase last year. And that's been a huge factor as to why we may see a recession going forward. Now, just a little bit of background on this. Part of the reason we got this is when we were shut down in the pandemic, government gave out a ton of money to everybody because there was no work going on, and people started spending it. Supposedly this was transitory. When we came out of the pandemic, we've seen that the inflation's still gone on. And if it wasn't there to begin with, it's been exacerbated by a few options. One is the zero policy COVID scenario in China, which limited manufacturing supply. So, of course, now all of a sudden limited supply, you're going to get an increase in prices. Another factor was the Russian invasion in Ukraine. Now, all of a sudden, we've got boycotts, we've got sanctions going on against commodity prices. That just also helping to increase it. So as we've seen all the way up in June, we had about a 9% inflation rate. It's come down since then, but that's part of what the background is for why we're in a possibility for recession.
So Kevin explained why we saw the spike in inflation. I'll talk to why we think that's an element towards a recession. You can see on the chart there, or perhaps on the printout, this is U.S. headline inflation, so often the number here quoted in the media would be this one. Canada would have a very similar graph for the Canadian headline inflation, but every time it's spiked above 5%, so whenever you've seen a spike in inflation in the past, that has happened either in a recession or just prior to a recession. So if we saw a spike of inflation like we just went through and we did not have a recession, that would be the anomaly. That would be the odd one out, because every other time in history it's happened, we've either been in a recession or one was about to happen. So if you're weighing the scales, weighing the evidence, and on one scale you have reasons why we could see a recession, on the other scale you have reasons why we might avoid it, this is definitely on the scale for the reasons we could see a recession. And related to this is interest rates, and this time around central banks were in no hurry. They actually delayed their reaction to this spike in inflation.
Yeah, the easiest way to try and tame inflation is to raise interest rates. And the reason for that is if you take money out of the system, nobody's spending it, you're not going to get any inflation. So that's the theory behind it. Now, what we've seen is a historic increase in interest rates. Now, it doesn't seem like that way. It's gone from sort of 0 to 4% on the bank rate, and the prime rate's gone from sort of 2.5 to 6.5. But that is roughly a 200 to 400% increase, which is huge in a comparative speaking. Not only that, but it's not so much the increase rate, it's the pace at which they did it. It was over a short period of time, a year, and as a result, this has had an impact on a variety of different things. On the housing market, whether people are getting mortgages, it's had an effect in the tech industry, where everybody was in before, during the pandemic, before they came out. And we've also seen this along the lines in various options of banking, such as the Silicon Valley banking scenario and how it's affected there. As a result, 2022, you saw both stocks and bonds go down, and that's part of the reason for it. But there's more to it on the interest rates, isn't there?
Yeah, we'll explain the chart here. This is from the Bank of Canada, Canada's central bank. It looks at the prime rate, specifically tracking the prime rate of interest from the major Canadian banks. And you can see the big scale, the big uptick near the last year. And I know often when we chat with folks about interest rates, they remind us that in the 80s, it went from 10% to 15 or 18, and went quite high, which is a big number. This time around, though, we went from a prime rate of 2.5 to 6.7, so it almost tripled. That magnitude of increase within 1 year is a record-setting pace. And that's really the issue, not the fact that rates went up, but the pace of the increase is why this is on the scale for reasons we could see a recession, because it caused lots of damage. Kevin mentioned some of that damage already. The housing market, house prices came down. The sale activity kind of dried up for a period of time. We also talked about the tech sector. The funding dried up for a period of time. Many tech stocks got hit pretty hard. The layoffs we are seeing are predominantly in the tech sector. Silicon Valley Bank and many of the regional U.S. bank players had some trouble. That's putting it mildly. Some of them imploded. This was one of the reasons why that happened. And, of course, last year, stocks and bonds both took a hit. One reason why, again, was the pace at which interest rates increased. So this is certainly on the scale of why we could see a recession. But we have to do a complete picture here, Kevin. We have to look at the other scale.
Yeah, we don't want to make it seem all doom and gloom. There is options that we can miss the recession completely as well, and we could have a soft landing. Now, one of the rationale that we've seen for why this may happen is the resilient labor market. And the rationale is, theoretically, in a recession, you see jobs dry up and you see unemployment go up. Well, since the pandemic, we've seen the opposite. We've seen an increase in the number of jobs out there. We can't fill the number of jobs that are out there, and we've seen unemployment at historic lows. This does not happen during a recession. These are key ingredients for why we may not see this going forward, because, as I say, as long as there's still jobs out there, if you lose one, chances are you can find something else. It may be a little different, but that makes people feel a little more comfortable in their reasoning for spending going forward.
Yeah, so this is certainly on the scale for why we could see a soft landing or a mild recession. The resiliency of the job market. The hiring, and this is coming to the chart there, the blue is the hiring pace, and you can see it's still at pre-pandemic levels. The red near the bottom of the chart is the layoffs, which are below pre-pandemic levels. And then unemployment rates in Canada as well as in the U.S. are near record levels. Unemployment in the labor market in general is usually a lagging indicator when it comes to recession. However, this is not recessionary behavior. You often don't hear people talk about recession and just how low the unemployment rate is. It's usually the opposite. So the labor market strength and resiliency is one thing that could help carry us through this economic rough patch. Another would be the spending.
Yeah. What we've seen, again, is usually when you have a recession coming on or you see increase in interest rates and everything else, taking money out of the system, you see less spending. We've seen the opposite. As the chart shows, inflation-adjusted spending hasn't dipped. It is continuing to grow. And again, a lot of that rationale you don't see during a recession. People slow down their spending. They don't increase it. So there are some ticket items being bought. Again, travel is still another big one because we couldn't go anywhere for 2 to 3 years, so that's still got spending going on. Those are a lot of the things that are there. Another factor would be the job security. People feel a little more comfortable to spend if they think that there's going to be a job. So if you lose one here, maybe you get another one. So when they've always said that you can't spend your way out of a deficit, that's probably true, but you may be able to spend your way out of a recession.
And that job security is a key point, worth repeating. If the labor market is so strong, you can see how the two are related here, and folks are secure in their current job or they feel, you know what, if I lose this one, there's probably a really good chance I'll get another job in quick succession. Well, they're probably going to spend a little more freely, and that's what the data is showing us. And again, the data here is inflation adjusted, which means people aren't spending more just because prices are higher. When you take that into account, the overall spending has still remained quite high. And consumers are a really big part of the U.S. economy. They're definitely a piece of the Canadian economy. We don't really have recessions in North America until the consumer starts pulling back. And right now, that's simply not happening. They're still spending quite freely, and that's what the data is showing us. So we're in a weird spot. We got data on both sides of the scales. How do you invest in this kind of environment? What happens if we do tip into recession? What do you do in that scenario? Well, we're not going to reinvent the wheel. We're going to look at the largest players in the investment world, the big pension funds, the endowment funds, the folks that manage billions of dollars. And one of the key takeaways is that they do things a little bit differently. Their portfolio looks much different than that of the average individual. They don't have big mutual funds. They don't have a collection of individual stocks. They have a far more concise portfolio, and they include alternative asset classes, ones that are uncorrelated with the public market.
Yeah, and the alternative classes are basically a lot of private debt and private equity that's out there. That's the more of the alternative. And as we can see by this CPP chart that's up there, that's the breakdown of what their investments look like. So you can see a section there for public equities and private equities. Then you've got infrastructure, real estate, credit, and fixed income. Well, the infrastructure and real estate is probably a private scenario as well, as can some of the credit and fixed income be. So as you can see, more than 50% of their portfolio is basically in an alternative investment. And that has been a reason why they've gotten to where they are. A lot of this started around that 08, 09. They've been around for quite a while, but it became more noticeable then. We had the Great Recession that went on. These were maybe 3 to 5, maybe 10% in these investments. As you see today, it's more like 50%. And the rationale is because it can help smooth out returns, and it doesn't have, as Clint mentioned, it is uncorrelated to other events that are out there or other investments that you have. So it does produce less risk going forward by having some of this in your portfolio.
And that piece is worth repeating, uncorrelated to public markets. A quick analogy or a quick example, I'm sure we're all familiar with Royal Bank, one of Canada's most profitable companies, tens of billions of dollars of profits every year, including last year. They made billions of dollars in 2022, but the stock still went down. The stock market and the economic fundamentals of the company are not always in sync. You can very much see a company do very, very well, but the stock decline. In fact, that happens regularly, and these alternative assets are not in the stock market, so they kind of detach that stock market piece. The sentiment you get, the fear and greed that can take over and push a stock one way or another, that gets removed, and you get more of a pure play on the asset, which tends to be more consistent, more stable. That's the idea. Those are the ones going to help out in good economic times and bad economic times. However, there's always a trade-off. The trade-off in this case would be it's a long-term investment. You can't buy an alternative investment and then sell it tomorrow. You usually have to hold it for a longer time period. Because of that, we always encourage folks to have the appropriate responsible weighting within their portfolio.
Yeah, and since it's not always that scenario that you can't get it quickly, that's the factor. I mean, it's not as liquid as a normal stock or bond, which you can get access to pretty quickly. Some of these can be a month, they can be 6 months, they can be a year before you have access to the fund at all. And a lot of it is because they invest the assets that they have. So again, it is a portion of your portfolio. Probably don't want everything in there, but it does help to enhance, and it's something that we can deal with going forward. But the liquidity, uncorrelation, and long-term, that's what we want to get to. So that sort of covers what Clint and I were talking about. What I want to do now is bring up Dennis Mitchell from Starlight. I'll give you a quick background on it. Starlight Capital is an independent Canadian investment management firm with over $1 billion in assets under management, global and North American diversified public and private equity investments across traditional and alternative asset classes, including real estate, infrastructure, and private equities. In regard to Dennis Mitchell joined Starlight Capital in March of 2018 as the CEO and CIO. He has over 20 years of experience in the investment industry. He has received the Bretton Wood International Canadian Top Gun Award in 2009, 2010, and 2011. He holds the Chartered Financial Analyst and Chartered Business Valuator designations and earned a Master's of Business Administration from the Schulich School of Business at York University in 2002 and an Honors Bachelor of Business Administration degree from Wilfrid Laurier in 1998. Now, I'm going to bring up Dennis now because the Leafs are playing again, and this way he can't watch and he has to talk to everybody else. So, Dennis, we're grateful you're here. Thank you. Here.
Well, okay. Well, thank you. That was a warmer reception than I was anticipating. They warned me that there were Jets fans in this town, not Leafs fans. So I guess nobody cares the Leafs are up 3-0 after the end of the first period, right? All right. So be it. So be it. There we go. So I'm going to, in 15 minutes, and if I'm looking at my watch, it's not to be rude. It's because I have a tendency to talk really fast and too much. So I'm going to try and stay on time and respect my fellow speaker. So I am Dennis Mitchell. I have the honor of serving as the CEO and CIO of Starlight Capital. I'm going to go out on a limb and say that not everybody here knows who Starlight Capital is. So Starlight Capital is a subsidiary of Starlight Investments. So on the slide here, what you can see is Starlight Investments is a North American asset manager. Sir. All right, how about that? Can you hear that? Okay. So we're going to go full-on talk show host. So Starlight Capital is a subsidiary of Starlight Investments. Starlight Investments is a $28 billion North American asset manager. The various businesses include, we are the largest residential landlord in Canada. So we have, call it 65,000 apartment suites spread across the entire country. We have 12,000 apartment suites across the Sun Belt of the United States. And then we have about 9 million of commercial real estate, mainly office and industrial, across the United States. So that's our parent company, $28 billion. They manage money for pension plans, insurance companies, endowments, and so forth. We started Starlight Capital 5 years ago. And we've built the business to about $1.1 billion of assets. That includes one acquisition we closed last year that doubled us in size. And we're focused on alternative assets. So I've been managing real estate and infrastructure money for 20 years now. And our business is real estate, infrastructure, diversified equities, both public and private. So that's us. So Clinton and Kevin, and fantastic job, guys. I get called to do these things all the time, and I have to say, the presentation you guys gave off the top was both informative, and you guys were actually engaging. So kudos to you guys. That was excellent. You did put it on a tee for me in regards to pension plans and their asset allocation. So what the slide here shows you is the 10 largest pension plans in Canada. And combined, they manage $2 trillion of assets for Canadians. And what the columns show you is that collectively they have 13% in real estate, 10.5% in infrastructure, 15.5% in private equity. So when you look at the 10 largest pension plans in Canada, they have 40% of their assets in alternatives. And I'm here to talk to you about infrastructure tonight. Hands up if you have 10.5% of your assets in infrastructure. That's usually how it goes. Right? We're going to be a little interactive tonight. I'm going to make you put your hands up a couple of times. No hokey pokey, though, I promise. So to begin with, the largest, most sophisticated investors on the planet have got 40% of their assets in alternatives, including 10.5% in infrastructure. So we're on to something here. Now, you might be saying, well, that's great. These guys have been around for decades. They've built this portfolio up over decades. Is it the right time now to be allocating capital to private infrastructure? Okay, so what is dominating the global economy right now? Two things. The dramatic increase in interest rates globally, right? The Bank of Canada hiked significantly. The Federal Reserve, the Bank of England, you pick a bank, and they've been hiking interest rates aggressively for over a year now. And inflation. So Clinton and Kevin have hit the nail on the head. Those are the two things really driving equity market volatility and market volatility everywhere. Well, how does infrastructure perform in environments where interest rates are rising or high, and when inflation is rising or high? So what this slide shows you is it shows you periods of rising and or unexpected inflation. And on the right-hand side, what you can see is that infrastructure assets deliver double-digit returns historically in those types of markets. Why? We'll cover that in a second, but what is infrastructure? I think everybody knows what real estate is. Infrastructure are businesses that provide an essential service in a supply-constrained manner to a big portion of the population. Okay, so toll roads, airports, bridges, electrical utilities, water utilities, gas utilities, high-speed internet, right? Cell towers. An essential service in a supply-constrained manner to a large portion of the population. Now, during high inflationary periods or rising inflationary periods, what allows infrastructure to outperform is often you have to pay more for the good or service because of inflation. Okay, so if you think of a toll road, once the calendar year flips over, that toll is going up by a minimum of inflation, right? Your water, your gas, your electricity, as inflation ticks up, you're paying more for those services, and the floor is what inflation has gone up by, right? The 407 in Toronto is probably the greatest infrastructure asset on the planet. Why? Because it was a 99-year concession, so it's still got 75 years to run, and the top-line revenue has grown by 14% per year on average for the last 25 years. Now, that's 4% in volume growth, right? So every year, 4% more cars, trucks driving on the 407, and 9% in toll increases. Okay? So those are the types of businesses you want to own in a in an inflationary environment. Right? So infrastructure outperforms in the environments that we're seeing right now. What about interest rates? How do infrastructure assets perform when interest rates are rising? Well, again, on the right-hand side, what you can see is that when central banks are hiking, 3 months after the start of the rate hike cycle, infrastructure outperforms. 6 months after the start, infrastructure outperforms. 12 months after the start, infrastructure outperforms. And again, it comes back to central banks are usually hiking interest rates because inflation is high and or rising. And so in those types of environments, infrastructure companies generate more revenue, more cash flow, and that's what allows them to outperform during rising interest rate environments. All right, so high inflation, high interest rates, good for infrastructure businesses. Probably a good time for those of you who don't have 10.5% of your assets in infrastructure to start building an allocation. And what should that allocation be in? Well, you guys have lucked out. I just happen to have a fantastic product that invests in infrastructure assets. It's called the Starlight Private Global Infrastructure Pool. All right, bit of a mouthful. What is it? Well, it is actually two investments in one. If you give me $100 to put into this pool, the first $20 goes into a portfolio of listed securities, and that's for liquidity. Okay, and that's to, cushion any redemptions you might need to make. Let's say the Jets make the Stanley Cup, right? Could happen, right? Right? I mean, I see a lot of jerseys out there, right? So the Jets make the Stanley Cup, you're going to the Stanley Cup, right? So let's say it's game one and you have to come to Toronto because we're there too. And hotels are expensive, right? An arm and a leg, literally. You got to fly over. So let's say you need an emergency withdrawal. The 20% that we put in listed securities gives us the liquidity to satisfy your unanticipated or unexpected withdrawal needs. Okay? That's all it's really there for, although we invest it and we generate pretty decent returns for you. The other 80%, so you're giving me $100,000 each, and the 20% goes into listed securities. The other 80% goes into private investments, private infrastructure assets. And we choose them based on the outlook for the underlying sectors we want to get exposure to. So, what have we invested? This pool is $130 million right now. So what private investments have we given you exposure to? Well, the first thing what we've done is we're going to give you exposure to the same things that these guys invest in, right? So we are going to take your money and we're actually going to invest in the same infrastructure assets and funds that these guys do. So that's one of the pushbacks I often get on infrastructure and real estate is, well, the pension plans, they invest directly in the asset. If you can do that for me, that's how I'd like to invest. Well, that's exactly what we do for you. A lot of the pension plans invest not in the direct assets, but in underlying private funds that are designed for them. And a lot of them are run by the likes of the companies you see here on this slide. So here's where we're going to get interactive. Okay? Who here today used electricity? Okay, I thought so. Was there anyone who didn't have their hand up? I'd like to see that person. Next Energy is the global leader in solar asset development. Okay, so currently we're invested in Fund 3. Fund 2 was wound down last year at a 25% total return to investors over the 6-year time period it existed. Their strategy is simple. They bid on RFPs to develop solar assets in OECD countries. Right? So the current portfolio provides enough electricity to power 450,000 homes for a year, okay, or per year. Okay? And if you think of what's happened in the world in the last year and a bit, Russia's invasion of the Ukraine sent power prices across the European continent through the roof. And every country accelerated their plans for rolling out renewable energy strategies. Right? You can't develop oil and gas assets. You either have them or you don't. But you can build hydro, wind, and solar within your borders because every country now understands that energy security is national security. Well, almost every country. 3 guesses on which country I think hasn't figured that out just yet. But Next Energy is one of the dominant developers of solar assets globally. Current portfolio is in the UK, the US, Canada, Portugal, Italy, Greece, Spain, right? And as I said, we generate enough electricity right now to power 450,000 homes. Right? So that's one investment. Put your hand up if you put garbage at the curb this week. Anyone buy anything online that had to be delivered to them? Okay. Astatine is a diversified infrastructure play. The 2 largest investments that we have exposure to in Astatine are a waste collection business and a cargo logistics business, right? And so those businesses are exceptionally resilient during recessions. In fact, the pandemic was a great example of the cargo logistics industry benefiting from the shutdown of the global economy. Because those of us who didn't shop online before the pandemic were forced to shop online during the pandemic, and a lot of us who didn't before have continued to do so afterwards. So those 2 businesses, garbage collection and cargo logistics, are exceptionally resilient businesses, and they're actually ticking along at about a 30-40% return for us since we started investing in Astatine. Put your hand up if you used a cell phone today. Okay. Peppertree Capital develops 85 to 90% of the cell towers in the United States and has for the last 20 years. Okay, the cell towers are probably the most lucrative business on the planet. And the reason I say that is this. It's really a simple business. It costs about $300,000 of concrete, steel, and fiber to build a cell tower. And then the telecom firms like Bell and Rogers and Telus or AT&T, Sprint, Verizon, Dish, they locate their equipment on the cell tower. You got 1 tenant on the cell tower, the return on investment's only about 3%. You get two tenants on the same cell tower, now your return on investment jumps to 15%. You get 3 tenants, now you're over 20% in terms of return on investment. $300,000 to build the tower. They are sold for generally $1 to $1.5 million. And who buys them? The publicly traded cell tower REITs. American Tower, Crown Castle, SBAC, and then there's TowerCo that's a private business. All right, so this investment we started allocating in September, and we're ticking along at a 30% return. All right. Put your hand up if you streamed a movie or a TV show this year. Okay, so that content is located on a server, right? So you go into Netflix and you search for rom-coms. I know you all do. And you pick the movie or the show you want to watch, and you hit play, and it streams from the data center where the server that hosts that show is on to your home over your high-speed internet connection. Interesting stat for you. 90% of the data that exists in the world today was created in the last 2 years. That is the pace of data creation in the world today. Think about it. Every Facebook like, every Instagram post, every movie, TV show that you stream, every LinkedIn post, every Tinder swipe, right? Every time you do something like that, you are creating data that needs to be stored on a server somewhere, right? Every time you come in and see Kevin and Clinton and they update your financial picture and they do their KYC and their KYP, that all creates data that has to be stored on a server somewhere. Iron Point is one of the largest developers of data centers we call them hyperscale data centers because you build these huge data centers that are just full of servers. They're the size of football fields, and you lease them to one tenant, Microsoft or Google or Amazon or Facebook, you name it. And so the development returns, Iron Point has generated 20% returns consistently. Last one, I promise. IFM. IFM is a $50 billion global infrastructure fund. It's domiciled in Australia. Most of the pension plans in Australia are owners. And of the $50 billion, $6 billion of it comes from Canadian LPs. All the pension plans and us. We're the only retail money in IFM. If you have flown from an airport, if you have ordered a package from somewhere other than Canada, or a good or whatever from somewhere other than Canada, if you have used electricity, if you've driven on a toll road, these are all the businesses that are in IFM. Right? To give you an example of the size of the acquisitions they make, the second last acquisition they made was the Sydney Airport in Australia. The equity check alone was $6 billion before you got into how much debt was assumed. Okay, so it is a very, very large, diversified global infrastructure strategy that gives you the opportunity to invest alongside teachers and CPP and the case. So when you put it all together, an investment in the Starlight private global infrastructure pool gets you exposure to an institutional portfolio of private infrastructure assets around the world. Services that you use all the time, every day, every week, every month in your day-to-day life. And so the last question is, well, we were talking about a recession. Are we going into a recession? Are we not going into a recession? So last piece of interactivity here tonight. If you are going to use electricity, water, a credit card, the internet, if you are going to travel anywhere during a recession, put your hand up. Electricity, water, credit card, that's what I thought. So if we do go into recession, this portfolio is invested in a number of global private businesses that will continue to generate strong revenue and cash flow growth even during a recession because they provide an essential service that you need whether GDP growth is 2% or negative 2%. You're still going to drink water, you're still going to use electricity, you're still going to access high-speed internet, and the list goes on and on and on. So that is my 15 minutes. Second period is about to start. So I'm going to yield the mic, and thank you guys, and I'll be back shortly.
All right. Just so you're aware, Dennis had a disclaimer as well. Lawyers love absolving people of liability, so he had his up here as well. And we'll move along to the next presentation. Michael Baker has the honor of speaking during dessert, so everyone's going to be happy as they eat some cheesecake. And Michael works for ICM Asset Management. So I'll do a quick introduction here. We'll bring Michael up as we finish the dessert. ICM Asset Management is founded in 2003 with the goal of preserving and growing wealth of retail, private, and institutional investors looking to diversify their portfolio with alternative assets, which fits with what Kevin and I were mentioning earlier. They manage about $2 billion of assets and offer an array of investments focusing on real estate, private equity, venture capital, and alternative income strategies. Michael Baker joined ICM in 2018 and is responsible for the client relationship management platform. Previously, Michael worked with McKinsey Investments. He received a business degree in finance and economics from St. Francis Xavier University in Nova Scotia and has a chartered investment management designation. So please help me welcome Michael Baker.
Everyone can hear me? All the way in the back? Thank you, gentlemen. Thanks for having me. Good to see everyone tonight, and I promise I will keep it reasonably concise, as I know we do have a game on the go. As I was introduced, my name is Mike Baker, and I work at ICM Asset Management. And without boring everyone with too much details, we basically manage capital on behalf of our investors, focused exclusively in real assets. And what I mean by real assets is that our firm does not make any investment into publicly traded securities, whether that be equities or fixed income. So very similar to what Dennis was touching on earlier, our focus is on investing into direct real assets that provide a more stable income stream, a more stable return stream, rather than relying on day-to-day market movements. So we manage a number of different strategies, and our clients range from retail capital right up to some of the largest pension plans in Canada. We've got business lines focused in real estate, private credit, venture capital, and then more bespoke strategies similar to what I'm going to talk to you guys tonight about, which is our music royalty strategy. So this might seem a little bit out there, but if you were to drill into many of the same pension and endowment plans that Dennis listed on his slide there, this is a major focus. Almost every single major institutional investor in the world is investing into music royalties, whether that be Blackstone, KKR, Apollo, the Ontario Teachers Plan, PIMCO. They all have exposure. And they have exposure because of a lot of the same reasons that we've touched on earlier. They're looking for return profiles that are more consistent. And more importantly, they're looking for return profiles that are not correlated to the broader market. And what I mean by that is this. Here's the simplest way I can explain this. Every time a song is streamed, used, performed, embedded in a video, there is a royalty right created, and it's paid to the person that owns that royalty. Okay, so if this gentleman in the front here with the Jets jersey, if you go out and record a song in collaboration with your band, and anybody else in the room uses that title on any platform, whether that be Spotify or Apple Music, or it's put in a Netflix show, you name it, there's a royalty rate created, and he's getting paid. So our business model is relatively simple. This fund is focused on going out and acquiring catalogs of music with the intent of holding them in perpetuity and collecting the income stream. Okay? So again, every time a title is used, a royalty right is created and paid. I'll quickly go through a couple of these things. You know, the first one I know we've touched on earlier, but low correlation to broader markets. This is really the key of why it fits within portfolio construction. This is not something that anyone goes out and says, okay, this is the next latest opportunity to make a big buck. It's simply that the return profile is different than many other things that would be included in traditional portfolio construction. It's a high-growing space. Obviously, streaming is a you know, we've got a lot of tailwinds behind it from a growth perspective. But more into some of the more kind of unique aspects of investing into music would be that the royalty rates are actually predetermined. And what I mean by that is that when we go out and we own music royalties, we don't have to go to the Apples and the Spotifys of the world and negotiate how much we're getting paid. It's actually set by federal statutes that determine how much of the total pie has to be paid to the rights holders. And in large, that's to protect artists, such as yourself, from too much of the cut going to the big co's, if you will. So we know what we're going to get paid, essentially, right? We know what that income stream is. So it makes it a lot easier for us to underwrite and actually acquire these assets. Probably the most important thing that I'll touch on is in the top right box. This is something that's pretty difficult to wrap your head around because it's very different than most other asset classes out there that have a pretty defined lifetime, similar to, take real estate, for example, right? We've got a big real estate business. Real estate does not last forever. Something starts as a development, the developer completes a project, the space is leased out, but eventually that space gets old, tired, and that has to be either redeveloped or demolished to then go through another development cycle. That would be a real estate life cycle. But in the case of music royalties, the income stream that's paid to the owners lasts for the life of the artist plus 70 years. So the life of the artist plus 70 years, which is really, like I said, it's hard to wrap your head around, but in many cases we're talking about acquiring a 120-plus year income stream. Another big feature of music royalties is that there's no operating expenses. Again, making the relationship back to real estate, for example. When you acquire a real estate asset, there's capital expenditure costs, and you're having to consistently roll your tenants, and et cetera. Whereas in our case, you almost have a scenario where your top-line revenue equals your bottom-line profit, because once you've acquired the IP, you just cash flow it, right? So maybe I'll back up a tiny bit here and actually lay a little bit of a foundation for what's going on in the streaming market. But if we look at what's happened in the music space over the last number of years, this really was not an investable asset class until, call it, 5 years ago. And the reason is that the music industry as a whole went through a very large transition phase where physical CD and LP and record sales dominated the industry. And then as that fade started to come into fruition, there was some serious problems with piracy. I'm sure many of you in the room would have remembered the kind of the Napster and LimeWire days where everyone was stealing music and no one was paying for it. And streaming was really the solution here. Streaming was founded out of the Scandinavian countries, hence Spotify's dominance. And nowadays, streaming is really the only economic driver of the music space that matters. It's really easy to digest. It's right on your phone. It's similar to what Dennis was saying. It plays into the kind of the infrastructure side where these things are just at your fingertips. So, the topic of tonight's conversation is how to invest during a recession. And similar to what Dennis touched on, where there's many services and many goods that are resilient to consumer spending, the digestion of content is extremely resilient, right? People are going to be far more inclined to go to a restaurant less than they would not digest content on Netflix, for example, or to give up their ability to listen to music on Apple Music. These things are viewed as utility payments as opposed to discretionary expenditures. So our pricing power is incredibly high, in the sense that we have a very consistent income stream that are paid to our investors. So there's some pretty meaningful growth rates. I won't bore you with all the details, but Goldman Sachs is probably the greatest follower of the music space from an asset class perspective, and they've got some pretty lofty growth expectations on where the space is moving to. I'll flip forward here and tell you a little bit about what our strategy is here, and it's really not rocket science. The thing that we're not doing is going out and trying to identify who the next latest and greatest artist is. What we are trying to do is acquire catalogs of music rights that have had some time to mature. And why that's important is that it gives us a trailing cash flow to be able to analyze and say, yes, this is something that we'd want to buy at this price. So the red kind of spike line, I'm sure that many of you would remember the viral video /song that came out, call it 10 years ago now, called Gangnam Style. And this would have been the perfect example of the red line, where You have a huge spike in popularity. At one time was the most watched YouTube video of all time. No one's heard of it since, right? It's gone off. It's gone by the wayside. Nobody cares. So what we're far more interested in doing is acquiring more iconic catalogs of music that stand the test of time, have a consistent income stream, and we're buying these things when they're 5+ years old, so that we know what that return profile looks like. And from there, all we do is we go out and source, which is the difficult part about our business model, is making relationships, having boots on the ground, having partnerships with talent agencies and the legal community in the United States where a lot of these groups would be domiciled, and actually going out and acquiring these assets. And from there, like I said, the business model is pretty simple. The assets cash flow. What's that? Country is very safe. Country, in fact, is it would be one of the most resilient, and it's got a large radio component, unlike other genres which struggle to get radio play, such as hip hop, for example. So yeah, country is the largest exposure in the fund. Fun fact. There you go. So I'll wrap up by just showing you this. There you go. Here's your answer. I'll wrap up by showing you this. Like I said, this is not rocket science here. We're not trying to go out and identify who is going to be special on a go-forward basis. We're just trying to build a catalog of well-diversified songs. And when I talk about diversification, it's diversification by genre. It's diversification by age. It's diversification by media, right? How are these songs being digested? What's the growth rate at which they're being digested? So right now we've acquired about almost 3,000 songs in the portfolio today, many of which you guys would know. We own the likes of Taylor Swift and John Legend and Tim McGraw and Faith Hill. Right? These are things that on a day-to-day basis, I'm sure many of you digest content from these people, and you don't know that you're actually making money for yourself. So maybe I'll wrap it up there and let these gentlemen come up for some closing remarks.
So now what we want to do is open it to Q&A. Anybody who's got questions, it can be general for both of them, or if you have something in specific you'd like to answer.
Yeah, that is a good question. It essentially gets to valuation, right? So if you're in the stock market goes up and down, but you know what you own and you know the price. Perhaps you could both take a turn at answering that. In a private investment like the two of you talked about, how do you determine the valuation?
Yeah, that's an incredibly important question. At the end of the day, the public markets set the price, right? The public votes with their dollars. It's very easy to see what things are trading at. And basically what that means is that's the price that someone else is willing to buy from you. So the public markets have a lot more transparency. There is not the same daily price activity in the private markets. Many of these strategies would be priced on a monthly basis. They'd be priced on a quarterly basis. In some cases, they're priced on an annual basis. But yes, in the case of us, and I know in the case of Dennis as well, we do have to price our securities. And in the case of the strategy that I talked tonight, the price would float on a monthly basis.
In our case, so we'll just talk about infrastructure. There's two buckets of infrastructure investments that we give you exposure to. The focused funds like the solar, the cell tower, those have fixed lives, right? So we give them money, they build cell towers, they build solar assets, they lease them up, they sell the entire portfolio, and we get all of our money back. And then if we like them, we invest in Fund 4, Fund 5, Fund 6, and so on and so forth. So in those cases, valuation isn't necessarily as important, but we want to make sure that there's a third party, an independent third party, providing us with quarterly valuations based on the cash flow that's currently being generated. And then at the end of the day, you sell something so there's no ambiguity as to what it's worth. On the other side, the open-ended solutions like IFM with diversified exposure to airports and toll roads and utilities. Well, guess what? There are publicly traded airports and toll roads and utilities. So it's really hard for IFM to say, well, this airport should trade at 30 times cash flow if the publicly traded airports trade at 10 times cash flow. So again, on that side, you have independent, arm's-length third parties who provide valuations, and they have to marry up with sort of the cash flow the businesses are generating and public comps. It's just they don't adjust the value every second of every minute of every trading day. So that's part of the due diligence process that we do. If you ever checked out my LinkedIn account, you'll know that I'm always everywhere, meeting with companies, touring their assets, and that's part of the due diligence to make sure we understand what we're investing your capital in and what the returns should look like and what are the risks. And I should say, it's not just your money. I'm probably one of the largest investors in our private pools as well.
Yeah, so to bring it back to the initial question, there was a great answer. It digs into the valuation question. I think you were asking about your capital, would it jump around a lot? The question is, it jumps around a lot less. The stock market's valued, seconds, every 10 seconds, every 15 seconds, whenever there's a trade. These would be valued on a lower frequency, so you wouldn't see all the volatility you typically would see in the stock market. Does that help answer the question? Yeah, good question. Do we have any others?
Yep.
The question was the safety of the markets, or are these markets, the infrastructure, the music royalties, if you could talk to the safety or security of the markets.
Okay, so great question. The answer is yes and no, because there are lots of companies out there that provide private investments who end up blowing up. Okay, and I'm not going to name any, but there are several that are in the process of blowing up as we speak. Okay, so as much as I do due diligence on the investments that I put your capital and my capital into, you have to do due diligence on us, right? Are these the guys who should be managing my infrastructure money, my music royalty money? And so, that's why you work with Clinton and Kevin, because they have the resources, the experience to adequately underwrite and, adjudicate guys like me and guys like Mike, okay? But I would say there are lots of investments out there in the private space that are suitable for people in this room, and there are lots that are not. And if you don't have the experience underwriting these types of investments, then you need to work with someone like Clinton or Kevin who do.
Did you want to add to that, Mike?
No, that's a pretty good summary.
Okay. Yeah, well, to give you our take on the investments we're talking of tonight, if we always use the risk ladder, from a 1 to a 10, so not every investment is suitable for every individual. It's all about a fit. A 1 out of 10, well, you're just sticking it in GICs. There's nothing wrong with that. That's the lowest risk alternative. A 10 out of 10, you're pretty much just gambling in Vegas, which can be fun, but not necessarily suitable for retirement. You're in the middle there, a 5, a 6, a medium risk investment. For the ones we talked about tonight, that's our opinion. You're kind of that medium risk level. More stable, more steady, but probably middle of the road in terms of the overall risk. Good question, though. We have one up front. Debbie? Yeah, the question was about dividend income, and I think Dennis cheered when he heard that.
So one of the great things about speaking to a group like you is when I make a mistake and I forget to mention something, you don't necessarily know, but I know. So I made a mistake and omitted something really important that Lou, my colleague at the back of the room, is like burning like that stare into me. So the Starlight Private Global Infrastructure Pool pays a 5% annual yield. You receive that yield on a quarterly basis. And the reason I'm cheering is because for the last 3 years, as long as the pool has existed, the distribution has been 100% return of capital for tax purposes. So not only are you getting a 5% yield, but you're paying the tax person 0 of that when you receive it. So it's a very, very high-yielding, tax-efficient investment vehicle in addition to the strong total returns.
The case would be the same on our side of things. Essentially, you can think about it like on a flow-through basis, right? So the underlying assets will produce a certain set dollar of yield, and then our coverage ratio would be the percentage that we pay to our investors. So right now, we pay out about 80% of the total income generation out to investors. The rest would go into either growing the NAV of the fund, additional acquisitions, et cetera, all to the benefit of the fund. But right now, the music royalty strategy is yielding about 7%. We do not have the ability to depreciate and amortize assets the same way that that Dennis's platform would, so that would be taxed as interest income in this case.
Good questions, though, and perhaps, before we come back there, I'll ask one that I had quickly. Related to catalogs, you mentioned buying, acquiring catalogs, you get that ongoing income stream, the royalties. Perhaps you can elaborate on how you find catalogs and the process you go about to acquire and value them.
Yeah, and I think that's a really good distinction, because when you think about going out and buying a publicly traded company, you can go online, you can see the stock, you can see the stock price, and you can buy it. It's not the same in our business, right? I mean, these are very ground-up type relationships where we're having to make the right inroads with groups to introduce us to people that are interested in selling their catalogs. So the headlines out there that I'm sure many of you have seen are the massive names, the
Springsteens.
The Springsteens and the Justin Biebers of the world that are selling their catalogs for hundreds and hundreds of millions of dollars. Those people, there's a very small select buyer pool, right? In our case, our typical acquisition is somewhere between 5 to 10 million. And there are very few buyers for these catalogs at that price, which means that you have to go out and build a brand and build a name of being reputable to work with. Close when you say you're going to close. Pay the price you said you're going to pay. And you kind of build a relationship from there. But we've got an advisory group that we pay out of our pocket to that are highly connected in the music space. Most notably, we work with a gentleman by the name of Devo Harris. He's a Grammy Award-winning artist, producer. He's actually Kanye West's cousin, and he was roommates with John Legend in university. So he's highly connected in the music space, and these are all ground-up relationships.
Yeah, the question was about, I believe, investment minimums. Yeah, I mean, for what we talked about tonight, it's really not the minimum for them. It's really for Kevin and myself. Because, again, to repeat, it's about suitability. You want to make sure you have the right allocation. You don't want to say, hey, I got $100,000, put the entirety of it in one investment. You have to get it within the right fit, and that's where Kevin and I, myself, can help you determine just how much should be suitable for your portfolio.
Yeah, I have one question first for Dennis. Okay, in the infrastructure space, Brookfield has an infrastructure fund that you can buy out there. Why would I want to buy something private if I can buy the Brookfield one instead?
Yeah, so question I often get. And so if you're dealing with Brookfield, first, very large, global, reputable asset manager, so I have nothing negative to say about them. But the mix of their assets versus what we can buy in a one-off and who we can partner with, like, for instance, Brookfield has got a portfolio of cell towers in India. They didn't develop them, they acquired them. So the returns they're going to get from that portfolio of cell towers in India is going to be far less than the return we are going to get via our Peppertree investment, where they will take our capital, build the cell towers, lease them up, and then sell them, right? And so I can use that example across all of Brookfield's assets to demonstrate how our fund will get you, and let's face it, if you're investing in private assets, you're giving up liquidity, you're giving up some transparency. For giving those things up, you should get more return, okay? More risk, you should be getting more return. And so from our standpoint, we are seeking out the best risk-adjusted returns. Some people in my household don't understand time zone differences. But for taking on that additional risk, you should be getting additional return. So it's my job to go out and find not just the best returns, but the best returns at a certain level of risk. So there are lots of people who develop cell towers. There are lots of guys who develop data centers. Because I've been doing this for 20 years, I know which questions to ask. I know how to screen these guys out. I have a director of compliance at the front end who vets the companies and their partners to make sure that we're not getting into bed with the wrong partner. We have an external investment committee that reviews any investment that we're proposing to make, and they have a veto. So if they don't like the investment we're making on your behalf, they say, no, we can't buy it. Okay? And then again, the ultimate check is my own money is there. Okay? And as much as I love you guys, I'm only going to see you once or twice a year. I got to stand in front of my kids all the time, right? And their money is in these pools too, right? And, you know, my daughter, I love her. She's in animation, so we don't have a lot in common when it comes to, like, business. But she knows how to read a brokerage statement, surprisingly. And so if we're not allocating properly and we're losing your capital, they'll come and see me first before you guys will get around to chewing up what's left.
I believe we had a question over here as well. Yeah, the question was about essentially liquidation, right? So you own the investment, you sell it, or perhaps you pass on and your state has to deal with it. How is it treated? In both cases, I think I can answer for you. If you own the units and you sell them 10 years later and the units have doubled, that would be a capital gain that you'd have to pay. Yep. Good. Perhaps just to be cognizant of the time there, did you want to ask one last question, Kevin, and then we could...
No, it's up to you.
Okay.
I've done one.
Okay, I will do it then. If you're going to force me to. I think it's topical. We mentioned inflation, we mentioned interest rates, how it relates to potentially going into recession. So I'll throw both of you the inflation question. We've seen a spike of inflation starting to come down, but how does inflation impact your businesses, and is it positive or negative?
So it's positive in the sense that assets that control pricing power are incredibly important in an inflationary environment. And what I mean by that is, let's relate it back to the strategy that we talked tonight. I'm sure many of you have received the same emails that I get for my dozen subscription services that I have, but when you get an email that says your Netflix now costs $13.99 instead of $12.99, you probably are not canceling it. So what that means is that these businesses have incredible pricing power, right? They're able to pass off incremental costs to the end user, whereas many asset classes out there don't have that same pricing power, right? Same thing on the real estate side. If you own a multifamily property and you've got tenants paying you rent, every time that somebody leaves that building and they're signing a new rent, well, then that's at market rate, right? You've got pricing power to move at least in lockstep with inflation and hopefully significantly more than inflation. So inflationary, real assets are incredibly important to own in portfolio construction during an inflationary environment.
Yeah, you pretty much got me there. I'm not going to cancel my Spotify subscription, so I don't even know how much it costs at this point. Same question to you, Dennis.
So the great thing about infrastructure is a lot of the businesses and assets are monopolies, right? So when you walk into your house, come in after having a lovely night at the Jets game, they won, and you turn on your lights, there aren't 5 or 6 light switches that say like Manitoba Power or BC Power, Ontario Power. There's one light switch. It's a monopoly provider of electricity in this market. And they're regulated, yes, but it's a monopoly. So it's not as if you can say, like, I think Manitoba Power is 4 cents cheaper this hour at this time of day, so I'm going to use that electricity today. So the reason I say that is because when you're a monopoly, you have ultimate pricing power. So as inflation rises, you have the ability to increase the price of the service you provide or the good you provide to keep up with inflation. And because we provide an essential service, I mean, people don't say, I need to keep up my Starbucks habit, so I'm going without electricity this month, right? Like, I need the newest Air Jordan, so I'm not consuming water this month, right? So because you provide an essential service in a supply-constrained manner to big portions of the population, it gives you that pricing power. And then the last point I'll make is that a lot of these businesses literally have inflation written into their revenue streams. So the toll or the tariff or the commission goes up every year by CPI plus or RPI plus or something PI plus. So these businesses have a tremendous ability to capture any upside from inflation in their cash flow stream.
Your Air Jordan to water component. You haven't met my kids. I think we'd like to take this time. We are running slightly over. Hopefully that's not going to be too much of a problem for anybody. Wanted to make sure everybody got to eat and everything along those lines. I would really like to thank Dennis and Michael for coming out today. They've flown in specifically for this event, and we really appreciate it.
Thank you.
Excellent to hear what they've had to say. Some closing notes Clint will get to. One thing I do want to mention is you don't have to go home, but you can't stay here afterwards. Clint and I will be hanging around for a little bit if you need any more questions. Other than that,
We do have an evaluation form, a feedback form. It was part of the PowerPoint slides that were printed out, so please fill that in. If you have feedback, what you liked about the event, what you're hoping we could do differently, or perhaps a different topic, we do read those, so mark it down. We would certainly appreciate it. I think that's it. Thank you, folks.
Thank you very much.
Yes.
Thanks a lot.
Yeah, it was great.
We love having speakers.
Thanks for having us. Yeah, absolutely.
They get tired of listening to us.
You too, eh?